Good afternoon, this is Sean Golding with Golding & Golding, here to take a step back and go back over the important aspects of FATCA, the Foreign Account Tax Compliance Act, for individuals who have to report. Now, FATCA has been around for close to 10 years. The reporting on the tax return has been around since, I believe, the 2011 tax return in 2012, and there's lots of different components to FATCA. For purposes of this presentation, we are just focusing on individuals who may have to file Form 8938. We're not dealing with withholding agents, foreign financial institutions, what they have to report, their exchange of information, exceptions, exclusions, or limitations within the different agreements. We're just focusing on you. You are sitting down, getting ready to do your tax return and realizing that you may have had to file this in prior years. Maybe this is the first year you have to file it. And out of all the different acronyms you'll come across, this is one of the more common ones, along with FBAR. We have a ton of other information on FBAR, but let's focus specifically on FATCA. So FATCA is the Foreign Account Tax Compliance Act. In or about 2014, starting then, more than 110 foreign countries and hundreds of thousands of foreign financial institutions agree to these reciprocity agreements with the United States, IGAs, they're called, intergovernmental agreements, and there's a couple of different types. But at the end of the day, what it means is these foreign financial institutions report U.S. account holders to the U.S. government in their country. So let's say it's the U.K. U.S. person may have foreign accounts in the U.K. The U.K. institutions report to the U.S. government, so the U.S. government has this information. As a quick aside, taxpayers who have to report FATCA will file it on Form 8938. And even though some of these agreements may not have been solidified until 2014 going forward, U.S. persons who file tax returns have had to report under FATCA since, I believe it was 2011 tax return in 2012. As I mentioned, there's lots of different components to FATCA. There's withholding agents, compliance, filing, reporting. Let's just focus on individuals. So first, who has to file FATCA? Well, it's certain U.S. persons. And while U.S. persons can include entities, we're just focusing on three main types of individuals: U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. Now, if you fall in one of the latter two categories and you make a treaty election to be treated as a non-resident, then you may be able to avoid having to file FATCA because you'd be filing a Form 1040-NR instead of a 1040, but there's also exceptions and limitations to that. So assuming you're a U.S. person, whether you live in the U.S. or abroad, whether you're a citizen or a resident, and assuming that you file a Form 1040, you will also have to file Form 8938. Form 8938 is required for FATCA when the threshold requirements are met, and they stagger and they vary depending on whether you are a U.S. resident or a foreign resident, whether you're filing separate or jointly or individual. If you are filing separate or individual, it's if you have more than $50,000 on the last day of the year, more than $75,000 on any other day. If you're married filing joint in the U.S., you double those numbers to $150,000. If you're living overseas, it's $200,000, and you're single or separate, it's $200,000 on the last day of the year, or more than $300,000 on any other day of the year. And if you're married filing joint as foreign residents, you double that number, $400,000 on the last day of the year, more than $600,000 on any other day of the year. We have a lot of information on our website too, so the goal is not to memorize, it's just to kind of issue spot when you're doing your returns. So similar to like FBAR, it's not only bank accounts that are reportable. That's what most people think of: a current account, a fixed deposit, a term deposit. It includes lots of different types of accounts: savings accounts, current accounts, investment accounts, pooled fund accounts, pension accounts, retirement accounts, certain life insurance, ownership of stock, if you have like DMAT accounts, stock accounts, it's all reportable. So for the most part, almost any type of foreign asset is reportable. Some exclusions might be something like if you're an individual and you own foreign rental property, that foreign rental property is not reported for FATCA, but if it's in an entity, then the entity is reportable. If you're generating income, that income is reportable. Just it doesn't report for Form 8938 if it's individually owned. Form 8938 is not mutually exclusive from the FBAR. I say the FBAR a lot because you see them entwined a lot in articles and presentations online. You may have to file Form 8938 and then have to file the FBAR as well. You may have to file other forms along with 8938 depending on what type of assets you have. There's 8621, 3520, etc., etc. So what happens when you're sitting down and you realize, darn, I should have been doing this in prior years? Am I going to get in trouble? Am I going to go to prison? What's going to happen? So first, as I always say in these videos, step back. 99% of the time it's not criminal. Most of the garbage you'll find online is just fear-mongering, try to scare you into thinking something worse is going to happen than actually it really will. Typically, there's 3 or 4 types of responses. The first one is nothing, right? There are plenty of people who will do nothing. We don't advocate for doing nothing. Attorneys can't really do that if you're supposed to get into compliance, but there are plenty of people who probably do nothing and they never hear from the IRS, right? Then you might instead get a soft letter, like a 6251 that says, hey, we received this information from bank A, B, and C. Your tax return doesn't reflect that you've included this on there. Go back and fix it, right? You may consider doing a non-willful submission, reasonable cause, voluntary disclosure, depending on the facts and circumstances. You may receive an audit or exam notice saying they want to audit or examine you on the various issues involving what's missing from your return and the information they have. And then sometimes you may just get penalties up front, typically by way of a CP15 letter. They're assessable penalties. Not so much with the 8938 and FATCA. You see that a lot more with 3520, 3520A, and 5471. Depending on what your facts are, either you'll be non-willful, willful, or willful criminal. Most people are non-willful. They didn't know about it. They misunderstood it. There was an error, and you go back and you fix it. If you're willful, you knew there was something you were supposed to do. Typically, you'll do what's called the IRS Voluntary Disclosure Program, VDP. That will help you limit the potential civil penalties, as well as 99.9% of the time avoid criminal prosecution. There has been a few scattered cases of taxpayers who were criminally indicted for FATCA, but it is typically not at the individual level. It's more like, for example, maybe an investment banker who steered U.S. persons the wrong way, higher level CEOs and things like that at institutions. But it's a relatively newer form. The 8938 FATCA is relatively newer, and so there's been a lot less criminal enforcement on that front. If you don't get into compliance, or you're in compliance and you don't pay what you're supposed to, like you've been penalized and you try to get it abated and you can't, or you do a reasonable cause submission or even streamlined and there's a penalty, you don't pay it, the IRS has various maneuvers that they can use against you. They can lien, they can issue levies, they can seize. Seizing is relatively rare, but they can do passport revocations, which has become much more prevalent. And you have to remember, the United States has entered into these treaties with many different countries. Oftentimes, the United States government will work with foreign countries in order to get that money that they think you owe. Typically getting a lien on your foreign property might be difficult, but that doesn't mean they can't levy or seize. If the main concern is that you're out of compliance for prior years, typically it's better to get into compliance for those years before doing the current year. There's various programs depending on whether you're willful or non-willful. As we mentioned before, if you're willful, you typically do the IRS Voluntary Disclosure Program. If you're non-willful, there's various other programs available, the streamlined procedures, delinquency procedures, and reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.